Okay, today we're going to talk about the true cost of a long-term care situation. Many people believe that an extended care situation simply comes down to money. If they work hard, they save enough money, they have enough assets, they can self-insure and everything will work out. Not only do they underestimate the true cost and the true financial cost of an extended care situation, they often fail to recognize the physical and the emotional burden that extended care situations put on their family members. Why are long-term care situations so expensive from a financial point of view? Well, number one is because income pays for care, not assets. Converting those assets to income requires you to pay unnecessary taxes. This pushes up your adjusted gross income, which also increases the taxes that you pay and also can push up the Medicare costs, which will start a snowball effect for taxes and other expenses. A dollar of care is a different cost depending on how you pay for that care. So here are options right here in front of us: $1.32, $1.25, $1, or 33 cents. This is what people are actually paying for $1 of long-term care services. If you're using retirement funds, $1.32. It might even be a little bit more depending on what your tax bracket is. If you're selling stocks or you're selling real estate, you've got to sell $1.25 of Microsoft stock to net that dollar to give to the caregiver, because you have to pay capital gains tax on that. If you're using cash, well, that's $1. But even that's not really true, because most people that are sitting on cash don't have it stuffed under their mattress. You might have it in a CD or a passbook savings account that is earning interest. So when you pull that dollar out, you're no longer earning interest with that dollar. And 33 cents or less, this is what people are paying when they set up a long-term care plan. Now, with a long-term care plan from 525 Advisors, you can do several things. Number one, you can basically pay pennies instead of dollars for that care. You can eliminate those unnecessary taxes. You can protect your savings and your investments, and you can protect the people you care about instead of putting that burden onto them. And lastly, you can get your premiums back if you never need care. Why should we care about long-term care planning? Well, because the odds are stacked against us. This is the statistics that the government puts out. 70% of us after age 65 will need long-term care services before we pass away. So during our retirement years, 7 out of 10 of us will need care. And there's a 92% chance, if you're in a married situation or a couple situation, that at least one of you will end up needing care before you pass away. In fact, this is the biggest risk that we face. A lot of us are worried about other things. If you look at this chart here, it's going to show you 1 in 1,200 is the chance of your house burning down. 1 in 240 is the chance of being in a car wreck. I mean, you've got about a 2.3% chance of ending up in a critical care situation in a hospital. And guess what? You have a 70% chance of needing long-term care. Without proper planning, long-term care situations will have a financial, physical, and emotional impact on the people you care about most, and it can very easily turn your last years into the worst years for you and your family. What is long-term care? Let's take a look at this. Long-term care refers to the assistance a person needs throughout the day when their health is compromised from either a physical or a cognitive impairment. It's a situation that is expected to last at least 90 days or more, and although some long-term care events are temporary, many go on for years and require permanent support. Long-term care includes custodial care and personal care. This is the care that we give our loved ones: the bathing, dressing, eating, transferring, help with continence, light housekeeping, meal preparation, transportation, medication management. It also includes things like skilled nursing care. So people that end up in nursing homes, they need that medical assistance. Long-term care includes that. It also includes physical and occupational therapy and supervision for cognitive impairment. Long-term care is different than medical care. Medical care is for acute care. Its goal is to cure us from an illness or to heal us from an accident. The purpose of long-term care is not to heal us, but to obtain and maintain an optimal level of functioning when our health is compromised, either due to that physical or that cognitive impairment, and we need help. Long-term care encompasses a wide array of medical, social, personal, and specialized housing services needed by individuals who have lost some capacity for self-care. Individuals who require long-term care services are not generally sick in the traditional medical sense, Instead, they require ongoing assistance due to that physical limitation, or they require supervision due to a cognitive impairment. Who pays for long-term care services? There are actually only two ways to pay for long-term care situations. Number one is private pay, which is often referred to as self-insuring. And the second way is long-term care insurance, which transfers that risk and the cost to the insurance company. Who manages your care? Extended care situations require complex, ongoing, and timely decision-making, which generally falls outside the scope of individuals needing that care. Many times that burden is going to fall onto the family members or friends, and having a quality long-term care plan is going to actually provide us access to a dedicated team of professionals who navigate the complexities of your care situation so that your family doesn't have to. What about government programs? This is a big misconception out there. Many people mistakenly believe that the government that is there to pay for long-term care when they need it. And although the government programs do exist, they do not pay for that ongoing care that we need, and they do not allow us to keep our assets on our income or stay in control of our care options. Medicare is our health insurance. It is for acute care. It does not pay for long-term care services. It does not pay for the first 100 days of long-term care. Technically, it will pay for 100 days of skilled nursing care, but that requires a 3-day stay in the hospital, and it also requires physician help or physician care. And actually, that first 100 days that Medicare will pay of skilled nursing is only 20 days. After that, you have a deductible of $226. That's as of 2023. And so that's for day 21 through 100. Medicaid is a highly regulated entitlement program designed to provide care for the poor. Costs are shared between the state and the federal governments. It provides minimal home and community care. In fact, most family members have to provide that care if you're trying to stay in your home. It also pays for about 80% of all nursing home beds in this country. Medicaid does. And the majority of Medicaid recipients are in nursing homes. To qualify, you must be devoid of any meaningful assets, and you must turn your income over. So that means you must spend your savings down as an individual to about $2,000 in most states, and you have to turn over your income, your pension, your Social Security, and that money is going to go first to pay for your care. And lastly, you will become a ward of the state on Medicaid program, which basically means you lose control of your care options. They will dictate where you receive care and what level of care that you're going to receive. The VA, or the Veterans Administration, this is similar to Medicaid. The VA is a means-tested program, which is the same thing. They're going to look at your income, they're going to look at your assets, and you're going to have to meet those requirements. There are some limited carve-outs, what they call for people that serve during active wartime. But again, you must qualify based on the need for care and limited assets, and you must turn your income over as well too. So the Veterans Administration is the same thing. It's an entitlement program for veterans, but more of a safety net program. What is long-term care insurance? Long-term care insurance provides a tax-free stream of income to pay for the ongoing care that is not covered by Medicare or traditional health insurance. Long-term care insurance helps you live in your home as long as possible. It helps you stay in control of your care options. It helps you protect your loved ones by making sure that your care is funded and managed in a time of need. And long-term care insurance helps you preserve your legacy and your wealth. Long-term care insurance provides immediate leverage. It provides tax savings, and it provides guarantees that we can't get elsewhere. It is the most efficient way to pay for an extended care situation. What triggers a long-term care event? How do we actually get those benefits out of a policy? Well, there's two ways this is going to happen. Number one is a cognitive impairment. So this is generally defined as a deterioration or loss of intellectual capacity. So that by itself, someone's diagnosed with Alzheimer's, Parkinson's, cognitive impairment will trigger a claim that will trigger your policy. The second way that you're going to get there is from what they call physical impairment. And we talk about this in the sense of activities of daily living, the inability to perform activities of daily living. And there's actually 6 of them: transferring, toileting, bathing, dressing, eating, and continence. It's really what we do every day. And what you need to understand is when you trigger a long-term care plan, it's your doctor who determines your eligibility, not the insurance company. How long will your benefits last? Well, long-term care plans are going to provide benefits from 2 years all the way up to an unlimited amount of time, or what we call lifetime benefits. The number of years refer to the minimum amount of time that that policy will pay benefits to you if you're pulling out your maximum monthly benefit. Unused funds that will stay in that policy, and you can use those at a future date. So that means that long-term care insurance policies don't exhaust based on calendar time. You have to exhaust a policy based by pulling out all that money. So they do not expire. You actually have to spend all your benefit down. Okay, what determines your benefit amount? Well, long-term care insurance, I want you to just think of a big tax-free bucket of money, a big bucket of cash, because that's really what it is. And when you set up a plan, you're going to determine two important aspects of your plan. Number one is how much money is in that bucket. So that's your total benefit. That's what we refer to as total benefit, and that can range from $50,000 up to an unlimited amount of money. Then the second thing you're going to decide when you put a plan in place is how much you can take out each month. That is referred to as your monthly benefit. So how much can I pull out per month to pay for care? And that's going to range anywhere from $1,500 to $20,000 on some insurance carriers. So you're deciding how much money you want in that bucket and how fast you can take that out. And you'll also note on there, you're also going to get to decide, do you want that benefit to grow? So if you put an inflation rider on there, your monthly benefit will grow and your total benefit will grow over time as well at a predetermined rate. How are those benefits paid to you? Once you go on claim with long-term care insurance, how do you receive that money? Well, the number one way is reimbursements. Reimbursements are just reimbursements up to your monthly benefit. So if you have $8,000 a month that you can take out of that bucket of money and you spend $7,500, they're going to send you the $7,500. The other $500 would stay in that bucket. If you were spending $9,000 a month and your benefit was $8,000, they would send you the full $8,000. So reimbursing you up to your monthly limit. Now, the provider is going to provide those receipts to the insurance company. The insurance company is now responsible for all the record keeping and the tax forms that have to be filled out. So they will take care of that for you. Funds can be paid directly to you. They can be paid to your power of attorney. They can be paid directly to the caregiver. They can even be paid to a facility if you move into an assisted living facility or adult family home. And with reimbursement policies, they're going to pay for licensed care only. It's what we refer to as formal care. Indemnity is the second way that we can get paid. That's also known as a cash benefit. So that's just going to give you that full monthly benefit regardless of how much you're spending. So if you have $8,000 a month of benefit, you will get a check every month for $8,000 regardless of whether you're spending $2,000 or you're spending $10,000. You will get your full monthly benefit. There's no receipts required to be sent to the insurance company. The insurance company is simply going to send you the money once you qualify and you trigger that claim. The client now has to keep the records. They will fill out the form IRS 8853 at the end of the year, which simply states how much money they received from the insurance company and how much they paid and to who. You can pay for formal or informal care, which means with a cash benefit plan, you are allowed to pay family members with your insurance proceeds. So reimbursement or indemnity, which is a cash benefit, that's the way you're going to get those benefits paid. What does long-term care insurance pay for? Well, there's a lot of things that encompass long-term care. It's a wide variety of social and community services to aid a person in an extended care situation. The number one thing that it pays for is custodial care. It's really back to those activities of daily living, the help that we give other people. So the transferring, dressing, bathing, eating, toileting, medication management, that is what we call custodial care. But if you follow the list down here, you'll see that it also pays for skilled nursing care. If you need skilled care, it will pay for therapy care, things like speech therapy, occupational therapy, personal care. That's going to include things like light housework, shopping, laundry, help with meal preparation, transportation, and also housing expense. If you move into a licensed facility, the long-term care insurance is going to pay the rent, the cable television, the total housing expenses. So those are some of the things that long-term care insurance will actually pay for. Where is care covered? So once you go on claim, where can you receive that care? Well, home is the number one place. Long-term care insurance used to be called nursing home insurance, but that has changed. About 3 out of 4 people will start their journey in their own home by bringing in those healthcare workers, those people to provide those services for them. But if we follow the list, there's a wide variety of places that long-term care insurance will pay benefits, including adult family homes, adult daycares, assisted living facilities, continuing care retirement centers. You're starting to see those spring up where you can go from independent living all the way to skilled nursing on the same campus. Special memory facilities for those people that have cognitive impairments, nursing homes, and even hospice care. Just remember, long-term care is not a location, it's an event. When is the best time to look into long-term care planning? Well, remember, your health is what determines your eligibility. Long-term care insurance requires medical underwriting. This means that insurance companies are going to consider your overall health before they agree to insure you. And what you need to understand is the qualifying process. That's called underwriting. It may be as simple as a phone call, or it may require a detailed look at your past and your current health. So remember, the healthier and younger you are, the easier the process is going to be to qualify for long-term care insurance. Age plays a role. Most companies work with clients who are less than 80 years old, but we do have limited options that go up to age 85. The younger you are, the less you're going to pay for that same amount of coverage. So your birthday, every time you turn a year older, that just means that cost of insurance is going to get a little bit more expensive, and that's solely based on your age. Non-cancelable, that simply means that once you have a policy put in place, you cannot lose coverage, even if you have a health change. The only way you're going to be able to lose that coverage is if you have ongoing payments and you stop making those payments. So look into planning while you're healthy, you're young enough to qualify, and that way you will have guaranteed coverage in the future, even if your health does change. Some final things here to consider about long-term care planning. There is no standard plan. As you learn about these different types of plans that are available on our website, keep in mind that there are no standard or what we call off-the-shelf plans. Instead, we're going to design those long-term care plans and we're going to customize them based on your eligibility, your financial situation, so that that plan that you put in place is right for your particular situation. Another thing I want you to consider is joint policies versus individual policies. A joint policy allows two people to pull money out of one bucket. So that's what we call joint, two people accessing one long-term care insurance policy. An individual policy is just going to be one person on that policy. And so individual policies will limit the benefits to one. Joint policies, we can have two accessing those same benefits. Tax deductions for premiums. Individuals may pay premiums up to IRS limits out of a health savings account. So that's a way that they can use tax-free money to pay some of the premiums. Now those amounts are going to be adjusted annually and they're based on your age. Individuals may deduct premiums if their out-of-pocket medical expense exceeds 7.5% of their adjusted gross income, and that's as of 2023. Businesses may deduct premiums up to those IRS limits, so the same limits that the health savings account. So a business owner, a sole proprietor, an S corporation, a partnership can deduct some of those premiums as well. And if you're a business that is taxed as a C corporation, you can write off 100% of eligible long-term care premiums. You're not limited to the IRS annual limits based on age. Be careful of averages. This is another thing I want everybody to understand. There are many reported figures out there on average cost, length of stay, how much costs are in your particular area. But remember, average claims paid by an insurance company now are 4 years. So that's how long the average claim lasts from an insurance carrier's point of view. However, 1/3 of those claims, the people that file for long-term care insurance, are going to pass away within the first 12 months. So we also have, you keep that in mind. So that just basically means if you make it a year, you're probably going to make it closer to 5 years. And we have claims that are over 15 years old. There's an active claim that's approaching 20 years right now. So be very careful of the averages. Make sure that you design a plan that will provide meaningful protection based on your financial situation, meaning the more assets you have, the more income you have, the more you have to lose, the more unnecessary taxes you might pay.